Hello, my dear students. In our lecture number 7, today we will start with page 115 in our textbook with the topic Types of International Bond Markets. The first topic in our course today, Eurobond. Number 1, the history. The first issued for Eurobond in 1963. Because unfavorable tax regime or problem in tax regime in the USA during this date, which make corporates to issue US dollar dominated bonds outside USA. So the main reason to issue the euro bond, some tax problems in USA during the 1960 decade, and this problem make or create a problem for the corporate, which leads to issue the US dollar dominated bonds outside USA. But euro bond, in case of euro, this word not the euro currency. Euro not the euro currency. So euro bond not equal euro space bond. The next, in Eurobond, we can define Eurobond that foreign corporates issue a bond denominated in a currency that is not the national currency for investors or for bond holders. For example, suppose US corporate issues bond and raise capital in Germany. We know that the official currency for Germany, euro. But in this case, when US corporate issues bond and there is capital in Germany denominated in US dollar, this case and a good example for euro bond. We can call euro dollar bond. In this case, euro dollar bond. Another example, or suppose the US corporate issues a bond in pound sterling, in the England pound, in Germany. So the official currency for Germany, euro, but the US corporate issues a bond in England pound or sterling pound in Germany. Yes, sure, this is another example for euro bond, but we can call euro sterling bond. Euro sterling bond. Generally, there is difference between euro bond and euro space bond. In case of our euro bond, as we explained that any corporate or a foreign corporate issues a bond denominated in a currency different to the national currency for the investors or bond holders. But euro space bond, we talk about bond denominated in euro currency. Generally, euro bonds issued in the offshore markets and not regulated by any specific country rules. The next topic, foreign bonds. Foreign bonds. In case of foreign bonds, we talk about a bond where a foreign corporate issues a bond denominated in the currency denomination of the foreign country. For example, we talk about the same currency for investors. But in case of euro bond, we talk about different currency for investors or bond holders. In our case, foreign bonds, another example, suppose US corporate issues a bond and raise capital in Japan denominated in Japanese yen. So the US corporate use the same currency for the bondholder or bond investor. In case of Eurobond, the US corporate issues a bond with a different currency for the domestic currency. In other words, in this case, Japanese investors avoided foreign exchange risk when a US corporate issues a bond in Japanese yen. The Japanese investors or Japanese bond holders avoid foreign exchange risk fluctuations. But what about domestic bond? In case of domestic bond, suppose a domestic corporate or in our example, Japanese corporate may also issue the bond in Japanese yen. When Egyptian corporate issues a bond with Egyptian pound, this is domestic bond. The same, suppose American corporate issues a bond in USA with US dollars, this is example for domestic bond. What about foreign bonds? When the foreign investor issues a bond with the same currency for the investors. Generally, when we talk about foreign bond, the bond issuer is from foreign country. But in case of domestic bond, the the issuer from domestic or the same nationality for this country. For example, another example, an Egyptian corporate issuing US dollar bond in any country belonging to Europe region, or example, this is a good example for foreign bond. Okay, generally, all foreign bonds don't any country specific name. يعني maybe some little bonds have interesting names, but not all bonds, not all foreign bonds that have the interesting names. For example, in USA, any foreign bonds sold in USA we can call Yankee bonds. Any foreign bonds in UK we can call Bulldog bonds. In Japan, any foreign bonds sold in Japan we can call samurai bonds, and so on. All in details in page 170. 117, table 3.1, foreign bonds name. But suppose we talk about foreign bonds in Malaysia. No name associated with this foreign bond issued in Malaysia. Talk about USA, UK, Japan, Netherlands, Spain, Canada, and Australia. All foreign bonds must be registered, and regulations. When we talk about regulations, it must be accept the rules and the regulations of the foreign country where these bonds are issued. For example, suppose Yankee bonds. What do we mean by Yankee bonds? Yankee bonds, any foreign bonds sold in USA. Any foreign bonds sold in USA we can call Yankee bonds. Must be registered with US Securities and Exchange Commission and must follow the same regulations for accounting disclosure and requirement of domestic bonds. We can use this example to say that all foreign bonds must be registered with the same rules in the country. Okay. SEC, abbreviation for Stock Exchange Commission. Stock Exchange Commission in USA as an organization which make organized for the Yankee bonds. Now, the next, This table on page 118, we talk about bond category, bond currency, and nationality of issuer. In case of domestic bond currency, domestic currency, or official currency. Nationality is the same nationality or domestic. Example, domestic bonds in Egypt, bond currency Egyptian pound, nationality of issuer any Egyptian corporate. Category number two, foreign bond category. In case of foreign bond category, what about the currency domestic or national currency or official currency? What about the nationality of issuer? Foreign nationality of issuer. In case of Eurobond two cases. Common, the bond currency, foreign, different for the official currency. But maybe two cases for the nationality of issuer. Maybe foreign nationality, maybe domestic or the same nationality. This table on page 180. The next, global bonds. Global bonds. Little corporates, mainly TNCS. TNCS equal transnational corporations. Issue the global bonds. The issuer supply the bonds to investors of many countries at one trip or at one go. At one trip or one go or one round, the issuer supplies the bond for many countries worldwide over the world. The next, like and alike. We compare between global bonds, some common with Eurobond and some different with Eurobond. Like Eurobond, global bond issued and supplied for sale in a lot of countries. At the same time, like Eurobond, the global bonds issued and supplied for sale in many countries. But unlike Eurobond, this is different between global bond and Eurobond. Unlike Eurobond, the global bond is registered security. Registered security, usually in USA. What about regulations? Regulations in case of global bonds. Global bonds held in common depositories such as Citadel Euroclear Depository Trust Company in USA. We can check about the website for our two examples. This is website for DTC, which means that Depository Trust and Clear Company in USA to manage the bonds. You can check the website, news, stories, business and subsidies, leadership, reports, managing risks, resources, client center, about the history, all services related to DTC in USA. The same in Europe, Euroclear, the same. Info about the organization. You will know that coronavirus is our problem today. So in case of emerging markets, in case of securities, all data you can check about the Euroclear other regulations or a manager for the global bond issue. Back to our lecture. Okay. The next topic, US government bond market. US government bond market. The main aim for any bond market, especially for the government, how you can finance or satisfy the public debt problem. Public debt problem, there is a gap between public revenues and public expenditures or public spending. This gap satisfied or financed by the public debt. Public debt, in our case, in USA, USA government bond, the main aim, how you can finance or how the US an institution, government institution can finance the public debt. In this case, the USA represents a significant amount of bond market, the very large part of US government bonds. Govies, what about this terminology, govies? Govies equal when the treasury agency, state of treasury agency of the country and central bank in central country may be also able to issue government bonds. We talk about government bonds as a govies. Govies, this is government bonds. This terminology issued by traders. What about the maturities? Maturities for US government bonds. We can distinguish between the bills, notes, and bonds based on maturity. In case of bills with maturity less than 1 year, mainly we talk about zero bond or zero coupon bond bills. In case of notes, the maturity between 2 and 10 years, maybe 6 months coupon period. 6 months coupon period. The last bonds when the maturity greater than 10 years. This the bills, notes, and bonds based on US market. Names worldwide. Some government bonds have the names in worldwide, like in case of UK, United Kingdom, the UK government bonds called gilts, were Japanese called JGPS for the Japanese government bonds. In case of France, French OAT. In case of Spain, we can call bonus. Bonus, this is the government bonds in case of Spain. The next, municipal bond market. Municipal bond market. In case of municipal, we talk about domestic area or local area in the states or local area in like USA. First, the municipal bond market issued by state or local government or domestic government as a debt instruments, securities, for the same reason public financing needs. Public or satisfy public financing needs, or maybe for specific projects, to finance specific projects. The advantage, what about the advantage for municipal bond market? This advantage related to tax, free from federal tax, or and local tax if issued by the state of residence of the bondholder. You can take advantage as a bondholder from the tax, free of tax. What about categories? What about categories for municipal bond market? Number one, general obligation bonds. General obligation bonds. Backed by the full face and a credit of the issuer for promote payment of principal and interest. This type of bonds is very safe since the guarantee is of unlimited nature. Safe because guarantee from unlimited nature. This means that the issues bonds have the right to raise tax up to able to pay the bond liability. What do we mean by these words? In case of general obligations bonds, suppose state A issued general obligation bonds to can pay the face value or principal of the bonds based on general obligation bonds. State A can increase tax or can add more tax to can satisfy the obligations for the bond or bond liability. This is first one. Number two, limited and special tax bonds. The same, backed by proceeds of a specific tax. This tax can be, for example, the backed, limited, and special tax bond based or backed by specific tax, like tax in gasoline, tax in any product or service. But there is a difference between limited and special tax bonds and the general obligation bonds. In case of general obligation bonds, we talk about the state can increase tax to meet the bond liability. But in case of limited and special tax, the issuer grantee is only limited to the source of revenue backing the bonds. So we can call relatively safe. Relatively safe. There is a limit for the state to can increase tax. But in case of the first topic or first category, general obligation bonds, no limit, unlimited for the state. Number three, revenue bond. In case of revenue bond, backed by profits or revenue producing states, agency, or enterprises. Examples for this category for revenue bonds, we talk about water companies or airports. In case of airports or water companies. So to evaluate, you can use the historical data to evaluate the risk. This type of revenue bond we can call risky, higher risk. Because higher risk, the yield of this bond is higher than the limited and special tax or general obligation bonds. Number four, industrial revenue bonds. Industrial revenue bonds. Backed by the corporate related to the Industrial Development Agency, IDA. Industrial Development Agency in USA. Industrial Development Agency in USA collected some branches or corporate to this organization and to finance the activities and the project of related to Industrial Development Agency. So the main purpose to develop the industrial commercial property for the benefit of private users. The same, these bonds risky. These bonds risky for a corporate and with a higher credit risk. For a higher credit or required high credit risk. Housing bonds. Housing bonds. In case of housing bonds, we talk about secured by mortgage repayments on single-family homes. For example, these bonds backed by, in all categories, you should explain which the main factor backed for this item. Backed by taxes or backed by housing, backed by agency like Industrial Development Agency and so on. Okay, housing bonds backed by federal subsidies for low-income families. Low-income families and Federal Housing Administration insurance and many or corporates or many institutions. Both states and local government can issue housing bonds. So housing bonds can issued by the state or state government or the local government to finance the problem of housing and also to solve the problem of housing projects. But in this case, talk about housing projects for the low income families. Low income families. And you can check in our page 121 the examples for in USA, BHA, abbreviation for Public Housing Authority issue. The next, moral obligation bonds. Moral obligation bonds. Maybe a weak trading volume with these bonds, but we talk about specific purpose. Specific purpose. Mainly we talk about the moral issues. For example, when we talk about public housing. And in this case, maybe appeared in New York since 1960. Double barreled bonds, barreled bonds. In this case, we talk about maybe two or more sources for granting, backed by a pledge of two or more sources. You can use tax with revenue. This is we can call double-barreled bonds. Tax anticipation notes issued by cities in anticipation of future tax revenues, and these notes backed by the expected tax. This is expected tax. Talk about tax anticipation notes. Municipal notes, this short-term debt issued by state or local authorities, maturities less than 1 year, from 60 days to less than 1 year. Tax anticipation notes, we talk about expected tax in the future. Bond anticipation noted. Bond anticipation noted. In this case, we talk about the issuer may delay the bond issue, however, still get some revenue. The issuer may issue the bond anticipation note backed by the bond issue to income. So there is a relationship between the income and bond. The last one, revenue anticipation notes, number 11. We talk about anticipation revenue coming in the form of federal government or local municipality may issue revenue anticipation notes backed by the revenue to come. Okay, in all cases, 11 categories for the bonds in USA or government in USA. So you can write in your own words about the source of backed. This is backed by revenues, backed by taxes, backed by some sources for the bonds. The next, corporate bonds. Corporate bonds. Three main categories for corporate bonds in our case. The first one, mortgage bond. Mortgage bonds. Bonds in this case backed by or secured by the real estate or and the physical assets of the company with a higher value than the one of the bond. So this is the backup or the backed by real estate or the physical asset with a higher value than the bond. By default, we can compare between closed-end versus open-end. Closed-end assets versus open-end assets. In case of closed-end assets, the assets used to secure the bond are restricted to this issue. There is a restriction for the asset. Open-end asset, no restriction, can be used for other issues with equal right on the collateral. No restrictions. This is the difference between closed-end assets and open-end assets. The next category, equipment trust certificates. Equipment trust certificate. The same, we talk about the main source secured for secured. Bond secured by fixed assets with depreciation rate is lower than the capital repayment on the loan. So we can compare between the depreciation rate and the capital repayment. Depreciation rate should be lower than the capital repayment on the loan. The last category in our topic, corporate bond, income bonds. Income bonds. In case of income bonds, bonds paying interests if earned by corporation. Usually, this case we can use in problem for banks, and in this case some banks failure to pay interest and the creditors agree the interest will only be paid to extend earned or allow company to survive close to any problem in banking. In case of banking problems, you can use the income bonds to create the bank come back. All banks which face a problem come back again to the banking system. Other classifications of bonds. In other classifications of bonds, we will use some categories to compare between the bonds based on interest, based on the registered or not, and so on. But first, you should know that there is many differences between bonds and stocks. Bonds and stocks. For example, stocks can be issued only by corporations, but bonds may be issued by corporations, by government, by municipals, by any different. In case of stocks, no maturity. But bonds maybe have various maturities, short run, long run, medium, and so on. All common stocks, for example, has the same characteristics, but only possible differences may be in voting rights, in classes, categories. But bonds, there is a big difference in all types of bonds. Big difference between all types of bonds. To can explain all details about the bond, this called bond indenture. Bond indenture. Bond indenture equal legal document specifying many topics related to the bond, like rights, obligations, the issuer, bondholder, about collateral payment dates, calls or put provision, seniority, and maybe another topics like which financial institution to act for the bond trusted, the bond registration, transfer of ownership, payment. We can talk about that bond indenture. This is protection for the bondholders. Protection for the bondholders. Maybe included in the bond indenture limiting for the payment may be at limiting for executive management's compensation may be restrict the issuing of more debt. This may be included in bond indenture like legal contract. Explain all factors, all sources, all data about the bonds. But sure, not all data included in bond indenture, like exception from this bond indenture, taxability, bond rating, may be two factors not included in the bond indenture. Now, we will explain another classifications of bonds based on some factors. The first factor, we talk about ownership structure. Ownership structure. In case of ownership structure, we can compare between bearer bonds and registered bonds. Bearer bonds and registered bonds. In case of bearer bonds, this is not registers, not with names. But in case of registered bonds, no. In case of registered bonds, the owner is registered with the issuer. The owner name, owner contact info, all items related to the issuer. Most registered bonds are now tracked electronically by e-commerce and the same payment interest of the face value. So the first classification based on ownership. The second classification based on coupon. Based on coupon. We talk about coupon bonds, zero coupon bonds or zeros, and deferred coupon bond. In case of coupon bonds, bonds make predicate interest payments. The payments paid some times, maybe every year, maybe every 6 months. We can talk semi-annual, maybe monthly, and so on. Every period over the bond's life. The payment every period over the bond's life. At a percent, maybe as a percent of the final principal, and all the final principal or the face value repayment in the maturity date by the end of bond life. As we explained that maybe the annual coupon payment calculated by stated coupon rate multiplied by the bond's face value. Say, suppose the bond's face value or principal equal 1,000. The coupon rate 10%. 10% semi-annual. So 10% multiply 1,000 equal $100. Paid, we talk about semi-annual every 6 months. But mainly the most common type of coupon bonds is semi-annual coupon. This is the famous coupon bonds. The next, zeros. Zeros, we can talk about the zero coupon bonds. Zero coupon bonds. This is terminology zeros. Bonds don't make any payments, any period payment. But what about the gains or profits or the earn for the bondholder? In case of bondholder, in case of zeros, the bondholder says the face value equal 1,000. The actual price which when you pay as a bondholder, say $900. So in this case, zero coupon. But what about the gain? The difference between face value and the actual paid for from the bondholder. This concept or zeros may be in T-bills and treasury stripes. The most famous example of zeros. In case of treasury bills, we can call zeros. Deferred coupon bond. In case of deferred coupon bonds, we talk about maybe coupon bond and zero coupon bond, mix between coupon bonds and zeros. Because it doesn't pay any coupon interest in the beginning of the life of the bond. In initial years, maybe the lifetime for the bond equal 10 years. In case of 10 years, maybe first 3 initial years or the first 3 years, no coupon. But maybe period by or you can pay a higher coupon after 3 years to compensate for no coupon. But in this case, deferred coupon bonds, we talk about lifetime equal 10 years. First 3 years, no coupon. But after 3 years, from year number 4 to year number 10, the interest or the payment higher coupon to make compensate for the first 3 years without any coupon. The next topic, based on maturity. Based on maturity. Talk about fixed term bond versus perpetuity bonds. Perpetuity bonds. The first, fixed term bond. In this bond with starting maturity date, which is the face value is paid back to bondholder. But most bonds have fixed term, no matter how short or long. This is fixed term bond. Because maturity date on which the face value is paid back to bondholder. But when we talk about perpetuity, the bond, in case of perpetuity bonds, no maturity, no the lifetime forever for the bond. In this case, no maturity and therefore no repayment. But in case of fixed term, the repayment when the lifetime for bond ended. In case of perpetuity, this is you can no repayment for the face value. You can earn the coupon for the end of life. The most example in our page number 128, British government consul or undated gilts. We can call undated gilts. Gilts refers to the UK government bonds. Started from the first issue dates in the date, note that 1720 decade. 1720. The last the last redeemed in 2015. 2015, this is the last date for undated gilt or British government consul. So if you can write in your own words, in case of fixed term bonds, and this is the common case, the issuer pay the face value or principal by the end of lifetime for the bond. Perpetuity, no payment for the face value, but the bond holder, will earn the coupon forever. The next, fixed rate bond, not fixed term, but we talk about fixed rate. Fixed rate bonds versus floating rate bonds. In case of fixed, where a coupon rate is stated as a fixed percent from the face value or principal. But in case of floating rate bonds, this is variable rate. We can call floater. Where the interest rate or the interest coupon, we can use a benchmark like LIBOR, like London Interbank Offer Rate, LIBOR. In case of LIBOR, London Interbank Offer Rate, or we can use another benchmark, Treasury Bond Rate, which adjusted each of time, sometimes adjusted periodically. So, in case of interest rate of floater, we talk about floating rate bonds. We can call that, for example, suppose the coupon rate on a variable rate 10 years corporate bond might be stated as 10-year T bond rate plus 2%. 10 year T-bond rate plus 2%. This type we can call floaters or floating rate bonds. So the bondholder will earn interest equal 2% as stated plus the 10-year T-bond rate. Now, how percent? Maybe 1%, maybe 3%, and so on. So in this case, there is a positive relationship between the benchmark interest rate and the coupon rate on floater, because they stated that LIBOR plus. Maybe the percent, when we talk about percent, in our example, 10-year T-bond rate plus 2%. 2% equal risk premium. Risk premium because when high credit increase, lower interest rate decreased. There is negative relationship between credit level and interest premium. When credit risk low, the risk premium high. When credit risk high, the risk premium low. For example, we can explain or write the credit risk by basis of points. For example, one basis of points equal 0.1%. 2 basis of points equal 0.2%. Suppose highly rated corporate bond might have floating or floater coupon rate LIBOR plus 25 bips. 25 bips, which means that you can write or translate price with LIBOR plus 0.25. 0.25. Okay, when we talk about bips, you can divide it by 100. Divided by 100. Another example, some floating rate bonds have a collar. The collar is a range for rate, minimum and maximum. Minimum percent and maximum percent. Suppose another example in page 129. Floating rate bond for equal coupon rate of 10 years T-bonds rate plus 100 bips with a collar from 2% to 5%. So in this equation, we will use factor number 1. 10-year T-bonds rate, say 1%, plus 100 bips. 100 bips divided 100 equal 1%. Can we talk about 1%? So 1% as a bips plus T-bond rate, say 2% equals 3. We compare between the collar 2% to 5%. In between, okay. Lower than the minimum, no. Greater than the maximum, no. So you can write, when we compare a collar, we take a range between minimum value and maximum value. When you finish the equation, how many? The rate, say our collar from 2% to 5%. So the coupon equals 6%. No, because the maximum 5%. The collar, the earn or coupon equal 1%. No, because the collar from 2% to 5%. This is another problem or another topic in case of floating rate bonds. What about the last topic? Inverse. In this case, inverse floaters. Inverse floaters. In case of inverse floaters, if you remember that we can call my coupon for 10 years T-bonds rate plus LIBOR. Now, when we talk about inverse, we were right. The 10-year T-bond rate minus minus any percent, given percent. This is inverse floater. Okay, but what about when we use the minus? In the first case, LIBOR plus 2%, for example. In our new case, we talk about LIBOR minus 2%. In case of inverse or minus, we talk about the benchmark because in the first case, positive relationship with the interest rate. But the next, negative relationship with the interest rate. So, for example, when we talk about 10% minus LIBOR, 10% minus LIBOR, when the LIBOR decreased, so there is a positive or good news for the bondholder. But when the LIBOR increase, this is bad news for the bondholder. For example, suppose our benchmark 10% in case of inverse floating, 10% minus LIBOR. In this case, if LIBOR increased from 3% to 4%, the first case 3%, so my coupon equals 7%. The next case, suppose LIBOR equal 4%, so my coupon decreased and reached to the 6%. So in case of inverse, when LIBOR increase, bad news for the bondholder. Maybe special cases in the variable rate for the bond or corporate bonds. We talk about step up bonds and step down bonds, step up and step bonds. In case of step up bonds, in page 130, bonds where coupon rates increased after a certain period. As we talk about, after 2 years of the bond lifetime, the coupon will increase. This is step up bonds or increasing in the coupon after certain period of time. The next topic, step down bonds. In this case, after a certain time of the bond lifetime, the coupon rate will decrease. Maybe we can use mix between step up and step downs. This is also called dual or multiple coupon bonds. We can use, suppose the lifetime equal 10 years. From year 1 to year 5, this is step up case, step up bonds. After year 5 to the end of the life of the bond, maybe step down bonds. So this is the last topic in our lecture today. We now at page 131. I hope you enjoyed with our lecture, and we will complete our time in discussion and simple questions in the Google Classroom. But please, you can register the attendance in your lecture time and answer the summary for our lecture. And thank you and see you in the next lecture.